Today, inshallah, we are going to continue with our problem solving. Of course, we started our problem solving in chapter number 8 with the problem 829. Today, inshallah, we are going to continue with problem 830, which is a continuation of the problem that we solved the last time. Of course, who would like to read for us the question? Yes, please, go ahead.
Continuation of 829. 1. Prepare journal entries for variable and fixed manufacturing overhead. You will need to calculate the various variance to accomplish these. 2. Overhead and variance are written off to the cost of goods sold and count to the end of the physical year. Show how the cost of goods sold is adjusted below journal entries.
Therefore, as this problem requires, we need to prepare the journal entries in order to journalize, according to our standard costing system, the fixed and the variable manufacturing overhead variances. Of course, in order to do this, in order to prepare our journal entries, we first of all need to calculate the different variances. Therefore, step number one, and of course, they said it in the question directly, that we first of all need to analyze the variances. We need to calculate the variances in order to prepare our journal entries. Of course, what information do we need in order to calculate the variance analysis, or in order to calculate the variances of the fixed and the variable manufacturing overhead? What do you think we need? The actual, yes, and the budgeted. And of course, in order to, let us say, divide the variance or the flexible budget variance, we need to further analyze this amounts or these amounts of the actual and the budget, and we need to determine what is the actual quantity and what is the actual rate, what is the budgeted rate and what is the budgeted quantity, in order to calculate the variances in the manner that we took before. Therefore, according to our solving of problem 829, we calculated the following amounts. Of course, these numbers are according to what we solved the last time. Of course, we have actual, flexible budget amount, and a static budget amount. First of all, the number of units. Of course, according to the question, the static amount that was presented in the question itself was 888. And then, according to the solving of the problem, we calculated that the actual number of units was 960. And of course, for the flexible budget, it would be the same for the actual 960. Correct? Therefore, this is given in the question, or question 829, and these numbers were calculated according to our solving to the problem. The second, the machine hours. Of course, they gave us the actual amount by the amount of 1,824. This number was given according to the question, but we, according to our solving, we calculated the static budget amount 1,776, and we calculated the flexible budget amount 1,920. This number was given, the 1,824 was given within the question. The 1,920 and the 1,776 was calculated according to what we solved the last time. Of course, then we have the variable manufacturing overhead costs. It was 76,000 608, of course, given within the question. 76,800, also given within the question. 71,040, also given within the question. And then the fixed manufacturing overhead amounts, all were given also. They gave us the amount of 350,208 as the actual fixed costs. And they gave us the amount 348,096 as the flexible budget amount, or as the static budget amount, and we deducted that this amount would be the same in the static budget. Of course, this number was not given for the flexible budget, it was given for the static budget, and we said that the static and the and the flexible budget amount is the same, because the fixed expenses would not or the fixed cost would not change according to the change in the number of units of the allocation base. Therefore, also the static budget amount is 348,096. Of course, in order to calculate our variances, we need to of course we have the quantities, because the machine hours was the allocation base, correct? Therefore, we have the actual quantities of the allocation base, and we have, of course, the budgeted quantities for the planned output as well as the actual output, which is the 1,920, correct? Therefore, we have the quantities of the allocation base. Now we need to calculate what? The rates, because we need the rate, the actual unbudgeted rate, and we need also the actual unbudgeted quantity, correct? Therefore, we need to calculate the variable manufacturing overhead rate. And we need to calculate the fixed manufacturing overhead rate. Correct? Therefore, how we are going to calculate the variable manufacturing overhead rate for the actual, the flexible budget, and the static budget amounts? What do you think we need to do? Yes. The number of units, the number of the allocation base, the number of units of the allocation base itself. Therefore, we are going to divide the variable manufacturing overhead costs, which are the cost pools, correct, by the number of units of the allocation base, which is the machine hours. By this, we are going, or we can determine the different rates for the different amounts. Therefore, we would have $42 for the actual, $40 for the flexible, and of course it would be the same for the static budget amount. Any questions? The same manner, the same rationale, we need to divide the cost pool for the fixed manufacturing overhead by the number of units, or the total number of units of the allocation base, which is the machine hours. Therefore, we need to divide the 350,208 by 1,824, the 348,096 by 1,920, and so on. Therefore, the rates would be as follows: $192, $181.3, and $196. Of course, this amount, the $196, was calculated from our solution in problem 829. If you can remember, the 196 was calculated according to the information that, or according to what we calculated in the last time. Also, the $40, which is the variable manufacturing overhead, was also calculated the last time in the previous problem. Any question? Now, we need to perform our variance analysis. We need to calculate the variances. Of course, we are going to use the 4 variance analysis. That means we are going to show the variances and the amounts, or the, let us say, the variances that will never be there for the variable manufacturing overhead and the fixed manufacturing overhead. This is the 4 variance analysis. Therefore, we are going to start by the actual. Which is, of course, the actual quantity of the allocation base multiplied by what? The actual rate. Then the actual input quantity multiplied by the budgeted rate. And then, of course, the flexible budget amount, which is the budgeted input quantity, of course, for the actual output, multiplied by the budgeted rate. And at last, we are going to consider the allocated amount, which for the variable manufacturing overhead rate is the same as the flexible budget amount. Because we are going to allocate according to our $40. Therefore, as we can see here, according to our flexible budget is 40. According to our standard budget it is 40. It didn't change. Therefore, the allocated amount would equal the flexible budget amount. And we will never have something called a production volume variance for the variable manufacturing overhead, as we discussed earlier. Any questions? Now, for the variable manufacturing overhead, the actual machine hours, or the input quantity, is 1,824 multiplied by the actual rate, $42. Of course, it would be, as we can see, 76,608. The actual input quantity, which is 1,824, multiplied by the budgeted rate with the amount of $40, which would be 72,960. The flexible budget amount, which is the flexible budget rate or variable manufacturing overhead rate multiplied by the input quantity, or the budgeted input quantity, but for the actual output, which is the 1,920. Therefore, 1,920 multiplied by $40, which will equal 76,800. Now, of course, for the allocated amount, it would be always for the variable manufacturing overhead, of course. It would be the same as the flexible budget amount, because we are going to allocate according to the $40, and we are going to allocate according to the number of units of the allocation base, which is the machine hours. Therefore, it would be the same, 1,920 multiplied by $40, which would be $76,800. Therefore, as we can see here, we have calculated the amounts. Now we need to calculate the variances. The variances are simple now. We need to calculate the difference between these different numbers. First of all, we will never have a production volume variance. Never a variance. And do not put a $0 in this part. Because if you say that you have a $0 variance, this means that there would be a variance, but in this case there wasn't a variance because these two numbers are the same. But as we took, we will never have a variance for the production volume variance. We will never have an amount that is allocated that is different than the flexible budget amount. Therefore, we need to say that this will never be a variance. Of course, we have a difference between the actual input quantity and the budgeted input quantity by the amount of the difference between the 76,800 and the 72,960. Of course, we expected to incur 76,800, but instead we have incurred only 72. Therefore, this would be a favorable variance. Of course, the amount is $3,840. Of course, this difference between the actual input quantity and the budgeted input quantity is the efficiency variance. Now, the difference between the actual or the budgeted rate and the actual rate, which is the spending variance. Of course, we should have incurred only 72,960, but we actually incurred more. We actually incurred 76,608. Therefore, this would be an unfavorable variance by the amount of 3,648, which is a spending variance. Therefore, as we can see here, we have calculated all the variances and we have pointed out that we will never have a variance of a production volume variance for the variable manufacturing overhead. Now, for the fixed manufacturing overhead, of course, the actual amount, as we can see here, is 350,208. Of course, the amount here would be the lump sum. Of course, this is the actual. This would be a lump sum amount. And then the flexible budget amount. And then the allocated amount. Therefore, the flexible budget amount for the fixed manufacturing overhead is, according to our example, according to our question, is 348,096. Of course, we said that we will never, for the fixed manufacturing overhead, we will never have an efficiency variance. Why? Because the change between the budgeted input quantity and the actual input quantity will never have the effect to change the costs. Why? Because regardless of the number of units of the allocation base, regardless of the number of machine hours in this case, we will never have a difference in the fixed manufacturing overhead because of this difference in the number of units of the allocation base. Therefore, we are going to use the same number as the flexible budget in this lump sum, 348,096. Because as we can see, the difference between the flexible budget and this amount would only be because of what? The difference between the actual and budgeted input quantity, which we said will never have an effect on costs or will not change our costs according to our understanding to the fixed manufacturing overhead costs. Of course, the allocated, we are going to allocate using the 181.3 or according to the 196. What do you think? The fixed manufacturing overhead would be allocated to the units or the machine hours using the $196 or the 181.3. What do you think? 181.3. First of all, we said that in cost accounting 1 that we need to calculate the predetermined or the budgeted rate at the beginning of the year or at the end of the year. What did we say in cost accounting 1 and even in cost accounting 2? At the or even before the start of the year, correct? Therefore, our rate would always be according to our static budget, because according to our definitions, the static budget would be prepared before the beginning of the year, while as the flexible budget would be prepared according to the actual output, according to the output that has been determined after the year has finished. Therefore, always the rates or the allocation rate would be calculated according to the planned numbers. Therefore, we are going to use the $196. Of course, we are going to allocate using the $196 multiplied by the number of units of the allocation base, which is 1,920. Of course, which is the flexible budget amount or the budgeted input quantity for the actual output. Of course, this amount would be 376,320. Of course, as we can see here, we would have a production volume variance. Of course, we allocated 776,320, which is more than the flexible budget amount. Therefore, we would have a favorable variance. By the amount of 28,224. Of course, we will never have an efficiency variance, but we can have a spending variance. Of course, we should have incurred 348,096, but we have incurred more. We incurred actual fixed manufacturing overhead by the amount of 350, 208. Therefore, this would be an unfavorable variance by the amount of 2,112. Any questions? Of course, after this point, we now are able to perform or to record our journal entries for the incurrence of the variable manufacturing overhead and the fixed manufacturing overhead, and of course the allocation of these costs. Any questions? Now let us perform or record our journal entries. Of course, according to our standard costing, we are going to have two different accounts for each type of cost. We are going to have a variable manufacturing overhead allocated amount or account, and we are going to have a variable manufacturing overhead control account in order to allocate and in order to record what was the actual cost, and the difference between these two accounts would be the different variances that we have calculated. Therefore, we are going to start with our variable manufacturing overhead. In order to recognize the actual expenditures of the variable manufacturing overhead, we are going to debit the variable manufacturing overhead control and credit various accounts. Of course, in this problem, they did not give us these details. Of course, these variance accounts could be wages payable, could be materials control, could be accumulated depreciation, could be accounts payable, and so on. But we do not have the details in order to detail these accounts. Of course, we are going to recognize here the actual amount, which is the 76,608. After this, we are going to recognize our allocation. Of course, the allocated amount would be the 76,800. And of course, we are going to debit the work in process by this amount and credit a contra variable manufacturing overhead control account, which is the variable manufacturing overhead allocated. Therefore, the work in process control would be debited and the variable manufacturing overhead allocated account would be credited, of course, by the amount of 76,800. Of course, at the end of the year, both accounts, both variable manufacturing overhead accounts should be closed, because these are cost accounts that should not be carried to another, or these are inventoriable costs that should not be carried to coming periods. Therefore, in order to close the variable manufacturing overhead control, we shall credit it, and in order to close the allocated or the variable manufacturing overhead allocated, we shall debit it. But as we can see here, there is a difference between these two amounts. Why do we have these differences? Because we have an efficiency variance and because we have a spending variance. According to our recognition, we are going to recognize these different variances. Of course, first of all, the variable manufacturing overhead allocated would be debited by the amount of 76,800, and the variable manufacturing overhead control would be credited by the amount of 76,608. Of course, as we said, the differences would be an efficiency variance, which is favorable, therefore it would be credited. Therefore, a variable manufacturing overhead efficiency variance by the amount of 3,840. And we would have also a spending variance, which is unfavorable, therefore it should be debited. Variable manufacturing overhead spending variance by the amount of 3,648. Any questions? Now, let us go to the fixed manufacturing overhead, which is in the same manner. We are going to recognize. Excellent. We are going to recognize two accounts. First of all, we are going to recognize the actual. Therefore, the fixed manufacturing overhead control would be debited by the amount of 350,208. And of course, also various accounts would be credited because we do not have the details in order to detail these accounts by, of course, the same amount, 350,208. And then we need to recognize the allocated amount onto the work in process or onto the units that has been produced. Therefore, the work in process control would be debited and the fixed manufacturing overhead allocated would be credited by the amount 376,320, and here 376,320. Of course, as we can see here, we have a difference between the actual account or the actual amount that has been incurred and the allocated amount. Of course, the difference between the two are regarding or are because of two differences: the production volume variance and the spending variance. Of course, which will be considered in the last entry. Therefore, at the end of the period, we need to close the fixed manufacturing overhead control, and we need to close the fixed manufacturing overhead allocated account by crediting or debiting, first of all, the fixed manufacturing overhead allocated, of course, by the amount of 376,320, and credit the fixed manufacturing overhead control by the actual amount 350,208. Of course, the difference, first of all, is a production volume variance, which is favorable. Therefore, we have a fixed manufacturing overhead production volume variance by the amount of 28,224, and we have a spending variance, fixed manufacturing overhead spending variance by the amount of 2,112. Any questions? Now, they need us not to prorate these variances to the different accounts, but they need us to write off these variances onto the cost of goods sold. And of course, we had a discussion: when do we need to prorate and when do we need to write it off to the cost of goods sold. Therefore, what do you think should be the recorded entry in order to write off these variances onto the cost of goods sold? If it is variable, is this the criteria that we are going to consider in order to debit it or credit it? Or it should be according to whether it is a favorable or unfavorable. Yes. Therefore, as we can see here, we have some of the variances that are favorable and some of the other variances that are unfavorable. Therefore, unfavorable variances are normally debit balances. Therefore, in order to close and write off these amounts and these accounts, we need to credit them. On the other hand, the favorable variances are normally credit balances, are normally credit accounts. Therefore, in order to close these variances, we need to debit these accounts. And of course, the difference between the debits and the credits would go to the cost of goods sold or would be carried to the cost of goods sold. Therefore, first of all, we have a variable manufacturing overhead efficiency variance by the amount of 3,840, and we have a spending variance by the amount of 3,648. We then have a production volume variance by the amount of 28,224, and we have a fixed manufacturing overhead spending variance by the amount of 2,112. And of course, as we can see here, the debits would be more than the credits because we have a $28,000 amount. Therefore, the cost of goods sold would be credited by the difference between these two numbers, which is 26,304. Of course, this entry is according to the writing off, to the cost of goods sold method. If we are going to prorate, therefore, instead of using only the cost of goods sold, we are going to use the work in process, we are going to use the finished goods inventory, as well as the cost of goods sold. And of course, we are going to prorate them according either to the ending balances or to the allocated amounts within these different accounts. Any questions? Let us start now with problem 831. Problem 831. Who would like to read for us this problem? Yes.
This Aram Corporation is a manufacturer of vehicles and uses standard costing. Manufacturing overhead, both variable and fixed, is allocated to product on the basis of budgeted machine hours. In 2012, budgeted fixed manufacturing overhead cost was $70 million. Budgeted variable manufacturing overhead was $10 per machine hour. The denominator level was 1 million machine hours.
Of course, according to the question, they gave us the fixed manufacturing overhead, of course, which is budgeted or planned. They gave us the rate, $10 per machine hour for the variable manufacturing overhead, of course, also budgeted. And they gave us that the allocation base is the machine hours. And they gave us the denominator level by the amount of 1 million machine hours. This is the denominator level. Therefore, this is the budgeted number of machine hours, or number of units of the allocation base. So what is the required or requirements for this question?
Prepare a graph for fixed manufacturing overhead. The graph should display how this program incorporations fixed manufacturing overhead cost will be depicted for the purposes of planning and control and the inventory costing.
Therefore, we need to sketch a graph that would show how we are going to use the fixed manufacturing overhead costs for two different reasons, for two different decision-making processes. One for planning and control, and the other for the allocation. So what do you think? Is there a difference between the two? Is there a difference between the cost that we are going to consider in order to allocate the fixed manufacturing overhead and the cost that we are going to consider in order to plan and control our processes? What do you think? Yes, and this discussion was took in Cost Accounting 1. So is there a difference or not? Of course, we said in Cost Accounting 1 that in chapter number 4 in job costing that we could not wait until the end of the period in order to calculate the costs of the inventory or calculate the costs of the units that has been produced, correct? And in order not to wait until the end of the period, we are going to use a budgeted or predetermined allocation rate in order to allocate the costs onto the units as these units are produced, correct? Therefore, according to the fixed manufacturing overhead, at the beginning of the year, we would have calculated the allocation rate. Of course, for the fixed manufacturing overhead, because the question here states the fixed manufacturing overhead. Therefore, what would be the allocation rate for the fixed manufacturing overhead at the beginning of the year? According to our question, they gave us $17 million, which is the static budget amount or the budgeted amount for the fixed or the planned amount for the fixed manufacturing overhead, which is the cost pool. Therefore, we are going to divide the 17 million by the number of units of the allocation base, which is the machine hours, and they also gave us the planned machine hours or the budgeted machine hours for the coming year. Therefore, we would divide the 17 million by 1 million, correct? Therefore, according to our standard costing system, according to what we saw in the previous question, we are going to use this $17 per machine hour to allocate our fixed manufacturing overhead on the units that has been produced. Therefore, from an inventory costing perspective, we are going to allocate $17 of fixed manufacturing overhead on the machine hours, therefore on the units that has been produced. Correct? Therefore, this is from an inventory costing perspective. But we said that we need to be careful when considering this $17 per machine hour. Why? Because according to our understanding of fixed manufacturing overhead, we are going to incur the $17 million whether we used 1 million machine hours or 900,000 machine hours or 1,200,000 machine hours. Of course, if we are talking within a relevant range, or we are considering these amounts within the relevant range. Therefore, for our planning and for our controlling decisions, we need to consider that this $17 per machine hour is, let us say, a wrong assumption of the fixed manufacturing overhead costs. Because here, as we took earlier, we are assuming that each machine hour would cost us $17. This is incorrect, right? Therefore, we need to carefully understand that this $17 is only used to allocate the costs, not to use it in our planning, not to use it in our controlling decisions. Therefore, in our controlling decisions, we are going to consider the $17 million as a lump sum amount. Because if we consider the $17, we might interpret this $17, or we might treat this $17 as variable manufacturing overhead. We might think that each machine hour would cost us $17 in fixed manufacturing overhead. Therefore, if the machine hours or the number of units of the allocation base would decrease or increase, the fixed manufacturing overhead would increase or decrease, which is a wrong assumption to have in our planning and controlling decisions. Therefore, our graph would be as follows. Of course, these are the costs and these are the number of machine hours. For the inventory costing purposes, we are going to consider the $17 per machine hour. Therefore, the fixed manufacturing overhead would increase in this manner. And of course, if we are considering the 1 million machine hours, we would incur $17 million in fixed manufacturing overhead costs. This is for the inventory costing purposes. But for our plan or planning and controlling decisions, we need to consider that these $17 million would not change, regardless of the change in these or in the machine hours or in the number of units of the allocation base. Therefore, for planning and controlling, we are going to consider that we will have only $17 million as a lump sum. It would not change. Therefore, we are going to consider this line for our planning and controlling decisions. Yes. Yes. Yani here, if we, according to our inventory costing, according to our treatment to the variable to the fixed manufacturing overhead as variable, we would incur $0 if we do not have machine hours. This is from the perspective of inventory costing. This is from the perspective of using the $17 per machine hour. Correct? We are treating the fixed as if they are variable, which of course is wrong. But according to our needs within the organization, we need to consider this for our inventory costing decisions. Therefore, according to this perspective, that each machine hour would increase our cost by $17, which is not the same as for the planning and controlling. And as we said, for the planning and controlling, we need to consider the lump sum amount, the whole amount as one amount. That means if we are not having any machine hours, I'm going to incur the 17 million. If I would have 500,000, I'm going to incur the 17 million. If I'm going to have 1 million machine hours, I will also incur the 17 million. Therefore, these are the two different perspectives of our analysis. Any questions? Okay, but we are going to continue inshallah with this problem the next time. Please read it carefully.